Asian trade. NYMEX WTI not far behind at close to 115. So clearly we're at very elevated levels, and we're at the kind of numbers you would have to say where the market is telling us that indeed Russian oil will be disrupted, is being disrupted, etc. So it's not a question mark, really, at least from the market's perspective. This is clearly an oil price that's betting in there is disruption. Let's kick off this morning with Ole Hansen. Good morning, Ole. Good to see you again. Obviously, head of commodity strategy at Saxo Bank. Ole, perhaps we could start with a slightly more wider lens now, a week into this crisis, where we are, and it's kind of dot connecting. We clearly see on the oil price, as we've just articulated, a big step up. Where is the connectivity across all markets?
Well, good morning. The connectivity is most certainly that the market is responding to the Russian Ukraine event, with the commodities that are directly and indirectly impacted reacting the most. We've seen a significant surge in gas prices in Europe, the crude oil price you just mentioned. We're seeing wheat prices, unfortunately, as well, surging higher to multi-year highs, even records on some exchanges. And then we're seeing in Europe some interesting developments as well in the carbon market, because we've seen carbon prices collapse this week. Speculative exodus, but at the same time also a potential belief that or speculation that Europe is taking it serious now, that we need to get rid of Russian oil and gas dependency over the coming years. And in the short term, perhaps some measures could be introduced that reduces the need for carbon. But we are already seeing prices in Europe starting to kill demand on the gas front. In oil, we probably haven't reached that level yet. There will be some reductions in Ukraine because the country is ground to a standstill, but that's not obviously not offsetting the loss of barrels we're seeing from Russia right now.
Robin Mills, good morning, CEO of Kamar Energy. Robin, let's talk a little bit about OPEC the morning after the night before, so to speak. OPEC met. They did as everybody had forecast them to do, roll over with a 400,000 barrel per day increase. But nonetheless, the silence is deafening. Your thoughts on the decision they made?
Yeah, it was exactly what I expected, but I still think they have their heads in the sand. I mean, how can you ignore events like this? And it was what was it, 14-minute meeting? I mean, the shortest of a series of very short meetings. And as you said at the start, Sean, we are seeing signs of actual disruption of Russian supplies, because traders will not load, banks will not finance. There's a big war risk premium to go into the Black Sea. So there are already ample signs that Russian supply is going to be severely diminished over the next few weeks. Now, yes, because tankers that were bought and sold just before the war are on their way to destinations, but further sales are very difficult. And we know that the market was already very tight. OPEC was already struggling to meet its own targets. Russia was actually probably maxed out on production capacity already, even before this. Now, so I think for OPEC Plus is not acknowledging that. At the next meeting, I think they'll be pretty squarely faced with it.
Andy Levin, good morning. Good to have you back at the table. Andy Levin, Chief Operating Officer at Sahara Energy Resources, but of course, many years a senior trader with BP. Would you like, Andy, to be back in that seat today, or are you happy you're not out of it? What do you think that wave that we're currently facing, is this a money-making opportunity for traders or run for the hills?
So I think, unfortunately, any war situation, any disruption always has the possibility of creating opportunities. However, I think part of the challenge this time around is it's a very different activity set, right? So we've got a war going on in Ukraine, but actually you've got an economic war going on outside of Ukraine. And it seems to be the majority of the world versus Russia, and they seem to be willing to go down a path that they've not been gone down before and do it in a very, very quick fashion. So you have people basically arresting oligarchs' yachts in various countries, right? And that's why the traders are saying, you know what, hey, it doesn't matter how cheap this is. If I'm not going to have it, I'm just going to get stuck with it. So I'm not even going to touch it. So the reality is it's actually making the market a lot tighter than the supply-demand balance really says it should be. And that's why prices continue to go up.
Ole, of course, it's not the only show in town. We had Jay Powell yesterday sitting in the midst of all of this chaos, trying to present an outlook to the Congress in the United States. Your thoughts on what he said and the guidance that you're seeing from the Fed and how it may impact all of this?
Well, considering he was read the Riot Act by President Biden back in December when he got his job reaffirmed for another period, he cannot ignore the inflation aspect, which is obviously not has deteriorated even further with these latest developments with the shot up higher in energy prices and commodities in general. So he was signaling that the rate hikes are coming. Perhaps not at the pace that the market was predicting or looking for just a couple of weeks back, but at least the hikes are coming, and the market took this quite well actually. The stock market, he was saying, growth is still strong enough to support that. So stock markets had a strong finish to the day yesterday, but overall, it just leaves us in a precarious situation right now. We have inflation expectations going up. We have interest rates going up. It can only, in my mind, lead to lower growth, and we're seeing that in Europe already. Probably the hardest hit area for now because of the gas prices. But we are likely to see economic slowdown, and inflation needs to be attacked. But at the same time, can you increase supplies in the oil market by raising interest rates, thereby getting inflation down? Of course you can't. So it's kind of disconnected right now. The efforts by the central bank and the actual impact on the market.
Robin, sort of pulling back the lens a little bit to the big geopolitical picture, we have the headline story on Bloomberg today. The improved Russia-China ties have ominous implications for the US and the West. Sort of big part of this equation is that partnership now emerging between Russia and China. Will this indeed fracture it? We did talk a lot a year ago about the sort of rise of China in a more robust way, and would there be a Cold War choice to be made? I'm wondering your perspective, again, the deathly silence for the OPEC Plus meeting yesterday. Given this sort of emerging global with us or against us, Team A or Team B here in the Gulf, can we continue to maintain a sort of I'm abstaining posture? How much stress do you think comes into that space? You're on mute, Robin, sorry.
It's a tricky position to be in, but all of the Gulf countries voted in favor of the UN General Assembly motion condemning the invasion. I think over the past few years, there's been this tension between them and their engagement with China. You recall a few kind of diplomatic incidents where the US was complaining about the Gulf semi-alignment with China over certain issues. I think just to go back to the initial framing of it, this kind of framing of Russia and China coming together, they have come together, of course, over the past few years. Russia very much as the weaker partner. I think this current invasion is not at all good news for China. I think it puts China in a very difficult spot diplomatically, politically, economically. The Chinese won't openly abandon the Russians, but it's not at all in their favor, this move. And China, I think if we think about the sanctions issue, China has been Iran's only kind of window on the world for its oil. It's not going to be able to play that role for Russia. And I think Russia perhaps counted on that. That's not going to happen. China will help out the Russians in certain ways under this economic pressure, but they can't possibly replace most of the rest of the world as an economic partner. So in terms of the Gulf, it does put the Gulf in a tricky position, but I think in the end, it's pretty clear who the Gulf security partner is. And I think the message of this of these events. So yeah, okay, the US has been unreliable in some ways. That the Gulf has had concerns about whether the US is really backing them up over certain security issues, particularly relating to Iran. But do you see Chinese warships coming around here, or Russian warships coming to help out the Gulf states against Iran or against any other local threats? And that's even less likely to happen now than it was a year ago. So I think that primary security partnership is probably more in place now than ever.
Andy, just picking up on Ole's comments vis-a-vis, are we heading into a stagflation recession structure potentially, right? The idea that this scale of commodity price, I mean, Robin's hinted that what is the pain for China? Substantial, biggest importer of energy of most commodities at these record levels. Your thoughts on how the market structure looks to you? Still deep backwardation, and yet you said yourself these prices are way above the actual tightness in the market. Are we heading towards a cliff edge or a kind of a slope down the other side of this valley? Where do you think this plays out?
So I think to a certain extent it's a mug's game to try and guess. I think part of the problem is that we've got so many moving parts to the puzzle. The increase in energy prices, especially if you look at the Western world, is a big part of the inflation. And if the energy crisis, as it were, was resolved, a lot of that would go away much quicker than any politicians or economics can actually impact the inflation. So it really is a crystal ball in terms of kind of what's going to happen. I do think this is going to be a watershed. It's going to be a watershed for the East-West relations. It's going to be a watershed in Europe. And depending upon how this whole scenario plays out, it may well be a watershed in terms of the global economics, right? So the thing I worry about from an economics perspective is, what is the exit ramp for Russia? Because if they keep going and if they were to ultimately take over Ukraine, I don't see the rest of the world.
Why do you use the word if? That's a funny word to use. They've got like, you couldn't have a bigger army surrounding Kiev. I mean, this is not an if anymore, right? They're about to smash it to pieces.
No, I think it is an if, right? I think if you look at, it doesn't matter whether you look at the Russian maps of what they've occupied or the European maps of what they've occupied, it's a small proportion of the country. Okay, there's got 40, as the Ukrainians themselves have said, there's 40 million people there. To subdue 40 million people, you need an enormous amount of troops, and they're struggling, right? So if they are able to take over and replace the current government, I don't see the sanctions being rolled back. I don't see them saying, oh, okay. Equally, if Russia turns around and says, oh, I'm sorry, we didn't really mean to do this, I can't see what the exit ramp for that is either. So unless an exit ramp is found, these sanctions are here to stay. I don't see them moving away, and I think they're probably going to get far, far stronger. That says energy prices are going to keep pushing forward and forward and forward. How long is it going to go on?
Ole, on that point, you mentioned obviously Jay Powell in the hot seat yesterday. Clearly, at least I came away from his comments saying this punch bowl is firmly still at the table. A quarter point here, a quarter point there is nothing given the scale of the inflation challenge. So the quantitative easing tidal wave that we've had that has inflated these markets for a while is going to continue for the foreseeable future, despite the headwinds inevitably of this conflict and rising inflation. Your thoughts on that?
I think that's true, because we most certainly have a certain amount of systemic risk in the system right now. I just took a look at the 4 biggest oil gas majors trading on the London exchange. Obviously, Moscow is still closed, but the 4 biggest Russian companies, they lost 95% of their market value since the invasion, and down to a few billions now. And that 190 billion loss within a week, obviously it's a little bit less now. We did see a bounce yesterday, but still a massive amount. That is ending up as losses in books around around the world at companies, at banks, and whoever has been lending on the back of otherwise relatively secure stocks in sectors that was really robust. So I think they need to they're still on standby for any input on that front. So it is really a balancing act, and I think also a reason why the market is fairly cautious on in their belief of how high interest rates can go at this point, and also basically what kind of impact it would have, because as Andy said, a drop in oil would be a much bigger impact than whatever a interest rate hike can do. And we also have to deal with now with a binary event, because as he also said, if we're digging ourselves down for a prolonged period here with sanctions against Russia, then obviously it will hurt us all. No one has mentioned the prospect of Putin perhaps leaving the Kremlin, but that obviously would be the best solution and outcome of this whole miserable affair. It will save a lot of problems for, I'll say, Saudi Arabia, for Middle East, for China, who wants to stay on good terms with Russia, but the current leader is toxic, so we need to see what happens on that front.
Robin, a lot of this market now, and hence the OPEC question, OPEC plus question, is, at least from the oil market's point of view, is obviously the geopolitical premium is chunky now, but also it's the supply demand fundamentals as well, given the disruption in Russian exports on the oil side, potentially how big they could be and for how long. The question is, there's no direct sanctions yet on oil and gas exports out of Russia, but yet there is disruption. And I'm wondering, from your perspective, how big do you think this disruption could be versus, let's say, OPEC has added, let's say, about 2 million barrels of oil since this August agreement has come into play, 400,000 a day per month. They didn't have meat at all. So on average, I've worked it out about 2 million. The Russian disruption, your thoughts, could it be more or less than that? And for how long?
Yeah, as you rightly say, OPEC has not been making up with its, it's been doing about half or best of its proposed increases. That's why the market was so tight running into this crisis anyway. As far as the Russian disruption, 7 million barrels a day of crude plus a substantial amount of products. Very difficult to say how much of that could be disrupted. But I think we need to look at the different channels. I mean, the question of, can traders and shippers and bankers touch it? Very difficult now. A lot of this is not real sanctions, but it's over compliance, and we've seen that on Iran too. Question is if the West steps up with more specific sanctions that actually target oil and gas. Reluctance to do that for now, I think. But actually, I'll see that the sanctions are pretty effective against oil anyway. Then there's a kind of physical disruption of tankers not being able or willing to go into the Black Sea to load. Question of the Druzhba pipeline, which of course runs through a little bit of Ukraine, but mostly through Belarus. Would that be cut off by sanctions or even by military action? And there's no real kind of alternative to that. You have refineries in Eastern Europe which are set up for that Russian crude. So there's a lot of possible channels of disruption there. The other one I watch for is CPC, Caspian Pipeline Consortium, which of course is about 1 million barrels per day of Kazakhstan through Russia. You've got various Western companies alongside Rosneft in that pipeline. Is that going to be disrupted because that also runs into the Black Sea? We've heard that shippers are unwilling to pick up CPC crude, even though it's Kazakh crude. That's another potential disruption. There's really a lot to add up. I think that the prospect of taking 7 million barrels out of Russian crude plus others off the market is so destructive that there'll be more of an effort to define some special channels, but the next month or two will be very chaotic.
Andy, is the Iran nuclear deal the cavalry coming over the hill for this oil market, or this tightness at least?
I'm not sure it's the cavalry. I think it might be a bit of a substitute for some of it. And I think it's also interesting to reflect on the way that the Western world, well, a lot of the world has been able to align behind sanctions. If you could get the same kind of alignment around Iranian sanctions, actually, you might get a very different deal, because the world has shown how quickly they can react if they need to react. I think Iran will help a little bit, but it's certainly not the Great White Cavalry. It's just a few extra people on horseback.
A few extra people on horseback. Let's get the view of the room on the survey question, which is touching on what I just discussed with Robin. OPEC Plus has added about 2 million barrels per day thus far in the current supply agreement since August. Do you expect Russian output to fall by less or more than that? That Russian oil exports, the disruption will amount to less or more than that? What is the view in this room? How disruptive will it be? Is it already? Might be the question. Ole, of course, this is the end of our Middle East week here with regards to the podcast. But it's Thursday early morning for you. Your thoughts on where this goes? Obviously, the trend seems to be, I mean, the trend, the unveiling in Ukraine seems to be a lot more destruction is around the corner. Your thoughts on where this goes towards this week? Prices keep going up and up and up, and on the ground, and where these two things start to impact each other.
Well, I think the momentum we have in oil markets now is likely to continue until something breaks, and that could either be maybe some peace talks that gather some momentum, or events related to the region. But it so far there's obviously no sign from the Russian side, at least, that they're scaling down. So they'll just continue to prolong the pain, and thereby also prolong the pain that that's being felt across these markets. And I can't reiterate enough how the real pain, because obviously we can just leave the car in the garage, but the real pain is the food price inflation that's coming with this. The rally we're seeing in wheat prices, especially some of the ones for human consumption, is just astonishing, and it really is a major concern, not only for the global perspective, especially in countries that can least afford it. So that's really the one part of the commodity space I'm watching quite closely as well.
And just on that point, the logistics of that, how quickly does that feed through to literally buying a loaf of bread or a pita bread in? I mean, I think in this neighborhood, countries like Cairo and Egypt, very heavily dependent on wheat imports.
It will take it some time. There are obviously the stock levels held in many of these places, but at the same time we're also seeing the production of bread, again, depending on how you do it. But in Denmark, obviously, bakeries, their ovens are run on electricity, and so that's just an additional dimension to the price rises that we're seeing. But it will start to filter through over the coming months, and again, we saw what happened in 2011. So it's something we really need to keep an eye on from a more global perspective as well.
Robin, your sort of closing of the week thoughts. Could we have an Iran deal this weekend when we're back here Sunday morning? That's what will be on the headlines. How close do you think we are to that?
I think we're pretty close, and we were very close before this crisis broke out. Obviously, the question is what impact the crisis has on it. Do the Iranians try and play a little bit harder, thinking that they're more needed now? But I think there's a very strong incentive for the US to close this deal now if they can. They need more oil on the market to back up the Russia policy, and they don't want another crisis in the Gulf distracting them. So very strong incentive on their side. Does this encourage the Iranians to try to hold out? And the other spoiler there is the Russians. Do the Russians try and slow this whole thing down? Realizing that the nuclear deal would be not in their interests right now. But how well connected is the Russian decision making? With the comments of Ulyanov suggests that he's not too plugged into the rest of the decisions going on in Moscow. So yes, I think on balance we probably do see a deal. It's helpful to offsetting Russian oil. It's as we've heard, it's anything. It's far from a complete solution.
Robin, just picking up on that point that Ole mentioned, this market keeps moving until something breaks. What do you think are the breaks, the potential? What would be the top one or two things that could be a break on this market, a fracture to stop it or turn it around?
Well, the only thing that turns it around from here, one, a resolution to the crisis, hopefully, but no real sign what that would be. The other resolution is a severe recession, right? That's going to cut demand very substantially. And we've been through a corona recession in 2020 that took 10 million barrels a day briefly off the market. We know what had to happen to get us to that. If we're losing Russian oil, we're talking something similar. Not to mention, of course, this time gas and a whole bunch of other commodities. Ole talked about wheat, very importantly, and a whole bunch of other things we haven't even started thinking about yet. A lot of critical materials come out of Russia and to some extent Ukraine. So I think we'll also see a lot of surprises across the energy and materials complex of things we hadn't been thinking about. But yeah, I think go back to the 70s, the oil crises. The way out of this is a severe recession and a big drop in demand.
Let's get the survey result and give Andy the last word. Do you expect Russian output to fall by less or more than that? More or less, more 2-1. Andy, you mentioned in your earlier comments that you don't think we've seen there's more substantial sanctions to come. What would you point at there, and how soon do you think that is? The obvious one seems to be on the energy.
Yeah, no, well, I think we're going to see more ratcheting up of the sanctions on the oligarchs. I think that's a very targeted individual thing that the West seems to believe will have an influence. I think actually it'll have a little bit of an influence, but it's not really going to make a change. And I think they're going to have to make some very, very hard decisions about stopping oil and gas flow. And I think Robin's absolutely spot on. My money is this price is going to keep going until we see a recession start. And then it's going to be very tough.
Andy, just to sort of drill down on the first question I asked you from your familiarity with the majors, obviously a lot of them have pulled out of Russia, at least announced that they're pulling out. Of course, it takes time to actually offload all of that equity and so forth. But from your perspective, what do you think? What is the time frame on that, and what's the legacy of that? What's the impact on these majors, do you think?
So I think there's going to be it's going to take many months for people to move out, right? So how on earth do you unload a 20% share in Rosneft? You can't do it in days and weeks and months. It's going to take a long time. I think it's going to make the Western companies, not just the oil and gas companies, but all are much more wary about what countries do they want to invest into and really understand what is inside that country risk. That means they're going to start investing in stuff closer to home, like you've seen in Europe, talking about building LNG regasification facilities. Once you've done that, the whole economics change. Do you really build new plants in Europe and then turn Nord Stream 2 back on? Or do you say, no, I've spent billions of dollars in these gas plants. We need to use these before we ever think about turning Nord Stream 2 back on. So I think that's why I said it. I think it's a watershed. No matter which way we go, I think there's going to be a radical change in the infrastructure and how the flows happen post the issues whenever they get sorted out.
Well, we're going to have to sort it out off air, because that wraps up our half hour together with Brent trading up nearly $4, moving in and around $117 a barrel. It's a big number, obviously has big revenue opportunities for the oil producing countries, maybe not the way they would want them, but obviously it will not be good news to the oil producing countries to hear this podcast this morning and the amount of alarm bells on recession on the horizon, given the scale of this, because with that, demand destruction is the worst enemy of them all, the volatility of revenues and how these countries struggle with that sort of planning around. But let's see, the next few days could be quite determinative. Where does Kiev go over the weekend? I wouldn't like to be there. That's all I could say, and wish the best to all that are, and that they have some adequate protection. Robin, thank you very much for your thoughts and contributions this morning. Ole as well. Very nice bedroom behind you. I'd have to pick up on those colors. Andy, thank you as well. All the best. Take care. Have a great weekend, everybody. Catch you Sunday morning. Mike Muller and Christoph Ruhl.
Thank you very much.
Cheers.